Welcome, fellow investors and traders. If you have seen my video aptly titled More Bang for Your Buck, you might enjoy this practice session, how to get our horsepowers on the road. Thank you for joining me on the magic 30-second timestamp. Most of the YouTube videos seem to have, so let's dive right into it, into our portfolio construction mini workshop, which is part of my series Fractal Portfolio Management. Quick introduction, and I promise one day I make a video that I don't have to repeat that all the time. My name is Thorsten Roland Wegener. I used to be a market maker. I learned the trade starting in 1995, went through the financial industry, became head of trading eventually, and retired as a partner at Bear Stearns. So that's all you need to know. Let's get into our topic of today. You might have seen my first video, More Bang for Your Buck, and I thought let's bring in a practice session, a sidebar on how I actually build a portfolio while taking everything I mentioned and more, obviously, in my video on portfolio construction and Markowitz into a practice session. So, mini workshop on advanced private wealth management. God, I love these titles. First of all, we have to have our goals. Portfolio construction, what are our goals? A smorgasbord of possibilities. Yes, we can do pretty much everything we want to do in each asset class all over the globe, long or short. For the purpose of this video, we are in a long only portfolio environment, and so far I'm not using any derivatives. So, creating a portfolio, the basic considerations, what are they? Define your goals and your risk profile, right? Formulate long-term goals. What do you want actually achieve? Retirement provisions, capital growth, cash flow preferences, and your time horizon. How long do you want to be invested? How much risk you want to take? But we're getting to that in a second. Asset your risk tolerance, e.g. what maximum drawdown is acceptable. At university, I was always told, the customer has a risk-reward function. You have to consider that. Well, if I would ask anybody of you, what's your risk-reward function? You would start scratching your head. I would, at least. So, but think in terms of what drawdown is just acceptable for me. Before I start really hating this game, how much am I willing to invest my hard-earned money into a market? And obviously I have to take some risk, but how much risk is acceptable for me? And we can simply judge that in drawdown. Makes it much easier to define your risk-reward function. And then obviously the consideration of your private tax situation now and in the future. I'm not going into that, but just consider the easy fact, at the moment you're working, you have a higher tax rate than when you retire. So obviously these are considerations which have to get into each step of our long-term goals we have for our portfolio. So we need a strategic plan for our asset allocation. So that means determine the preferred degree of diversification, taking into account your long-term goals. Obviously, you've all heard by now that you want to be diversified. It simply protects you against the surprising facts markets can throw upon us, and diversification is time-proven, Nobel Prize-proven. That's what professional money managers do. They diversify a portfolio. The question then is, where are you leaning towards? Are you leaning to more risks? Do you want to have more high tech in your portfolio, or the really safe stuff like government bonds? All considerations which obviously go in line with your risk-reward function. Then analyze, compare, and optimize historical data. Do the work. Where do we start? I hear so often, and it's true, that the past is no guarantee for the future. But you have to start somewhere. Whenever you just look at a chart and it goes from bottom left to top right, you've already done a back test for your judgment. You decided, okay, would I want to be in this investment? Or if you see markets going from top left to bottom right, you think, okay, is it bombed out now? Is it going to zero? So you have already done ocular regression. You've already started a tool with a backtest. So that's what we're going to do as well. We need the data, we look at the history, and we hopefully can derive some insights out of that. And the adaptation to your individual lifestyle, age, inheritance, start of the planned portfolio, unwinding phase. Why is that important? You want to build up a portfolio for your retirement, to send your kids to university, all plans you might have, and you have a time horizon for that. And then you have considerations, okay, how long do I plan to live? Obviously, nobody knows that, but do I want to use all the capital I've already built up over the preceding 10, 20 years? or do I want to have something which I can pass on as an inheritance, or am I planning to live to 120 as the first person around, so I need more money? These are all considerations which you have to take in. There are simple formulas for that. It's called an annuity. We're not going into that today because I think it would be a bit too boring, but eventually I'll make a video about that as well. So, implementation and continuous optimization. Capital growth phase, e.g. dollar cost averaging. That's a nice way of getting into portfolio. If you're not hunted or haunted by current market fluctuations, markets go up, markets go down, but we've seen a perpetual growth rate over the long term. As long as you are in a free society, it's a fair assumption to say, yes, asset markets will rise as long as we have productivity and a free market and free exchange. That might be completely different in the future, but then you're probably not going to invest anyway. Then you're trying to survive. Monitor your asset allocation, and if necessary or desired, reallocate. Nothing we do today has to be put in stone, but we make the best assumptions how the reality looks at the moment, and we have ideas about how it could be in the future, and that's how we are setting up our portfolio while mixing different risks and different reward profiles, at least assumptions, into the whole mix. And then follow the plan, suppress impulse actions. You've seen all the statistics. If I would have cashed out at a certain point in the market, then I would have missed the best 2-3 days, and that has a tremendous impact on your portfolio. If you are too afraid to take risk, you might cut yourself off from this fantastic long growth path. Equity markets, bond markets, commodities are delivering in the long run. So this is a slide I have in my first video, just giving you an idea. You can pause it here. I'm not going into the detail, but it is an idea about how I and a lot of professionals out there create their portfolios and are managing it. I made a joke about that in the first video. If you want to see it, I recommend you watch it. So let's start. What, when, and why? We start from scratch. First of all, as I said, we have to define our objective. Long-term capital accumulation with the aim of entering the unwinding phase after 20 years. Let's assume you are in your 30s or in your 40s, you want to retire by 60 or by 50, and you say, okay, fine. I have 20 years. In these 20 years, I'm putting money aside and invest that in equity markets, and I'm doing it not just equity markets, asset markets. There you see my background. Into an asset portfolio, and I want to build up a reasonable amount of money from which I eventually can draw down once I've reached the stage of getting into retirement. Define your risk appetite. For this example, I said maximum portfolio drawdown for us shall be 10%. And I'm going into that a little bit later because that comes with probabilities, obviously. And how are we defining that? Then I've decided I want to put in my portfolio a mix of equities, properties, precious metals, bonds, and cash. I haven't put volatility in here yet because we are still working in the mundane world of long-only asset investments. And then obviously we have to consider the tax situation. I mentioned that briefly before, but I can't get into this part right here in this presentation. That is something more advanced, which is individually special for each and every investor. So, a smorgasbord of possibilities. What do we have? We have our asset classes here. Again, I've asked the good people of Grok to give me long-term returns, long-term volatility for the biggest asset classes that are out there, because the purpose is to get different risk buckets available. And I've just highlighted this a little bit in what is seen as low-risk assets. That we have cash, we have government bonds, we have real estate, and surprisingly, we have precious metals, especially gold. If you follow the recent gold price, then the more risky but higher rewarding markets, corporate bonds, FX trading, equity markets, and commodities, and then the high-risk products, volatility products like every strategy you can do if you are well-versed in the option markets. We're talking about probabilities which can deliver you very good returns. You can steer the risk you want to take. that is, if you check out on this channel, there are a lot of videos out there how you can employ derivatives into your portfolio construction, and I'm promising you there's another video on the way which is doing exactly that. And then obviously crypto. I had a conversation with a very accomplished crypto investor. He said, don't call crypto, they're not all the same. He's a big Bitcoin fan and he has the money to prove it. And he said to me, no, don't put it in the red bracket, put it in the green. Long term, you have to have Bitcoin is the safest investment ever. I'm not going into that in detail here. For the purpose of this presentation, I left it in the high yield, high risk, high reward bracket of the portfolio, because simply that's what the historical data tells us. So why is it a fractal structure? Because in our portfolio, I simply start with creating 3 risk brackets. And I say, okay, I want to have a low risk, a medium risk, and a high risk bracket. And I pretend, how would a portfolio look if I put 100% of my wealth in each and every of this bracket? Because the optimization process comes as a second step. So, creating a portfolio, identifying asset classes. In this, in the low risk bracket, I've put in, especially for this purpose, the house I'm living in. The cash I have, cash could be short-term governments or overnight money market rates and government bonds. Then in the medium risk bracket, I have equities, I have gold, and I have corporate bonds. And in the high risk, I have cryptos, I have volatility, and I have trading strategies. Yeah, these could also be investments in a fund of your commodity trade advisor. They all have risks, they all have rewards, and we can measure that. At least we can pull the data out of it. Then I've asked the good people of Grok, give me the proxies I could most likely use. And then we have a couple of ETFs for the housing. We have the VNQ. For cash, we have SHV, the TLT, SPY, obviously the S&P 500, gold for the GLD, etc., and then Bitcoin in here. And the next step we're going to do is we say, okay, fine, show us the historical returns. And you've seen here one little asterisk. I haven't put my money into REITs. What I have done, I said, okay, consider the average house in the United States over the long run. What is the volatility and the risk? The reward we can get out of that. And Grok came up and said, on average, you have a growth rate over the long run of 8% with a volatility of 8% around this growth rate. What does it mean? It means within a corridor of 68%, you can expect long run 8% returns, but it could be 8% higher. Yeah? It could be 16% a year, or it could be at 0 with a 1 standard deviation. Could be higher or lower, but a little bit about that, more about that a little bit later. Then we have here equities. You've probably seen these figures. Over the last 10-15 years, we had a return of 10% and a volatility of 15% in the S&P. Over the long run, it was more like 7%. I'm plugging these figures in anyway we have here. And one of the points I wanted, the government, TLT, you see here, we have it here, minus 0.8%. So the assumption that bonds will always rescue you when equities tank was not true for the last 15 years we had in there. Why? We had a huge bond crash coming in. So even with the coupons you received while holding government bonds, long-term government bonds, you made a loss. Yeah, and you had huge volatility. If you compare the volatility in the government bond market, TLT, 12% versus equities, 15%, and then the returns. Things that have worked in the past don't necessarily have to work in the future. So the question is, will I be invested in TLTs because I think the market is now at the bottom, or will I not? Simple rule for our portfolio construction exercise: if we have a negative long-term return, I'm not going to put this asset in. So I put in a couple of secondary conditions. I say I want to take the governments out, the TLT, in my starting portfolio, and I also want to take out additional trading strategies because I haven't taught them yet, and that will be the second step. So we are left with what you see here in front of you. So, secondary condition, I also said, no, I want to put this money I'm not spending into, I'm not investing into the TLT in government bonds. I want to keep that in cash. As I said, cash could be very short-term government bonds because it's very unlikely that the government is not able to pay back your money after 3 months and there's less volatility in there. So in this portfolio actually, where I hold my personal property, my house, the value you can write on yourself, I want to have 20% cash. Yeah? I'm pretending that is all I'm having at the moment. I have a house and I have cash. In this portfolio, I say, okay, I simply say I want to have equities in here, I want to have gold in here, and I want to have corporate bonds in here, but I don't want to hold more than 10% corporate bonds. And in the second basket, I was saying I only want to have cryptos and I want to have some volatility products in here. You see, I've done the first optimization run already, and we can see here the returns and risk of the portfolio on the next slide. If I look at the first bucket, I have no degree of freedom in here. I simply said, yes, I want to hold my house I'm living in, and I want to hold cash. So this gives me a return of 6.8% with a volatility of 6.4%. The second portfolio had an optimization process, which I explained in my book. There's no book. In my first video, More Bang for Your Buck, where we're using Markowitz to optimize a portfolio. Is simply the mixture. Where do I get the best degree of payout for which mixture of assets I have in there? And it tells me the best mix of assets where I have the Max Sharp portfolio, also in the last video, is 71% in equities, 19% in gold, and remember we had a condition in there that I only want to have 10% in corporate bonds. So this gives me a return of 8.7% and a risk of 12.16. That's the volatility. And the mixture, the Markowitz portfolio, the optimization puts out is I should be invested 71% in Bitcoins and I should be invested 29% in volatility products. So that's the fractal part. And now we put it all together, right? What we're doing is we say, fine, now that I have these green payouts, I can use that at asset A, asset B, asset A, asset B, and asset C. Oh, see, I made a mistake here. There should be an asset B. Anyway, so I take these three assets and run them through the optimization process again, right? Because I've calculated for each individual bucket, and then by mixing and matching all possibilities of asset A, asset B, and asset C, the optimization process tells me, all right, we can have here a weight of 58% in your portfolio, which contains your house and your cash. We have 21% in our portfolio, which gives us the medium risk, equities, gold, and corporate bonds. And we have our high risk bracket, which gives us 20% of the money I have should be invested in crypto and in volatility strategies. This overall portfolio now with these weights gives us a return of 14.23%. and a volatility of almost 11%. What is that in numbers? If you have 100,000 US dollars, that would simply mean I'm putting 58,000 in my low risk bucket, 21,000 in my medium risk bucket, and 21,000 in my high risk bucket. Funny enough, they are the same. Yeah? And that adds up to 100,000, all individual asset mixes you can see down here in this line. So, what have I achieved with this? You might remember, if you've seen the first video, the green dots are all possibilities of mixing asset A, B, and C in various quantities against each other, and we have a risk-free rate. So this portfolio, when I can borrow money or invest money at the risk-free rate, in our example I think it was 4%, I want to have this portfolio that is just touching this capital market line, because the capital market line can tell me I either invest everything in risk-free bonds or I invest everything in this portfolio, which has the best bang for our buck in here, which we just computed. So I've just zoomed in a little bit. You can see here, this is 100% invested in our portfolio. And this would be 50% investment in our portfolio, 50% risk-free rate and 50% in this portfolio. So we're only moving up and down this line. And in this case, I have leveraged. Yeah? I borrowed money at the risk-free rate and put it all in this portfolio. So I'm moving up on this yellow line and get a return here of 19.35% while taking a higher risk volatility of 16.19 into consideration. Yeah? So fine, we have our portfolio worth, and now I'm coming up with a couple of secondary conditions and say, okay, fine, this asset C is too highly weighted in risk terms. I want to have that at a maximum of 5% of my overall portfolio. All right, let's do that. We are cracking up our portfolio engine again, do the optimization, which means I'm taking up in this cloud of A, B's, and C's. I'm taking up my low risk bucket, my medium risk bucket goes down, and my high risk bucket goes down as well, because I said it's only 5%. That's what it's supposed to do. So I put a pin in there, and the return of this new portfolio is 6.68%, and the risk, the volatility around it, is 8.8%. The individual mix, you can see here again, how much money do I invest in each individual assets. So we started here, that was the sharp, the optimum portfolio, and now we're here. You see we've massively reduced our risk in the portfolio, but the reward as well. And what you can also see, this is still the 4% risk-free rate. We are not touching this little optimum sharp portfolio here anymore. So we have a suboptimal portfolio by mixing that. What does that mean? Here, the maximum sharp portfolio had 8.8% reward and a risk of 6.68. With the special conditions that we have only 5% in the high risk bucket, and that was the portfolio we used to have before when we had a higher risk, in a higher contribution to the high risk bucket in here. Yeah? So very clear, 6.6% risk. Yeah? And before we had 10.79% risk. If you're now really risk averse, you would say, yeah, well, why don't I go in the low risk bucket? Yes, I'm willing to sacrifice return. Then let's have a look, because that's what I mentioned at the beginning. We want to define our risk appetite through the drawdowns we have. This is the original optimized portfolio without any secondary conditions. It has a return of 14.23 and a risk of 10.79. So now we're going into what we as market makers, option traders, always work with. It's a model, and it's a so-called bell curve. And it's based on the assumption that over the long run, returns are random. Yeah? We have a growth path in there, but all the daily returns, monthly returns, yearly returns are somewhere around a mean. And they do that with a 68% probability, and that is the volatility here, of 10.79% for our portfolio. What does that mean? 68% of the time we will end up on an annual return here somewhere. 16% of the time we will be above that, and 16% of the time we will be below that. That's two standard deviations. Yeah? In 95% of the time we will not be lower than 21%, and we will not make more return in 2.5% of the time than 21% to the upside. And then we have the three standard deviations. Markets do all sorts of weird things, so that is a possibility that could happen, but it happens only in 1% of the time. So in 99% of the time, you will not exceed your maximum drawdown of 32%, or to the upside make more than 32% with 0.5% probability. So what we're going to do now is we forget all the secondary conditions we put in there, because we've already seen that was suboptimal what we have here. We simply take the yellow line and move our maximum sharp portfolio up or down by saying, okay, the risk is too high. 10% within one standard deviation, could get me up to 30% or even more. I don't want to take that risk. My risk-reward function makes me cringe in the night. So I now have the opportunity, while doing every step right, I've done an optimization, I have assumptions in my model, I have the perfect mix. If I assume that the history will develop, or the future will develop like history, obviously that's a big question, I'll come to that later as well. And in this case, I simply take down the investment part in my risky portfolio until I achieve a risk of 5%, right? So obviously the reward goes down as well to 8.71 from 14.23, but the risk is not longer 10.79, it's now only 5% because the risk-free asset, by definition, doesn't have any volatility, right? So now I can see here 54,000 go into the risk-free asset and 46,000 go into my maximum Sharpe portfolio. What does that mean for my drawdown? Same again. Now, in this portfolio, I have a drawdown within one standard deviation, so 68% of the time, of minus 5%, two standard deviations, that 2.5% to the downside, because that's what's interesting us, of 10%, and 0.5% to minus 15%. Far more manageable if you say, I prefer less risk and I'm willing to surrender some return to that. Okay. Let's have a look how this portfolio, the Max Sharpe portfolio, now we're again 100% invested, would have done in the future. I did 10,000 simulations over the course of 20 years, 240 months in here, and on average, out of a 100 would have grown to 1,541, and the risk-free investment would have grown to 222. But before you now start getting out there, taking out mortgages on the house and play this game, let me go into the model assumptions and the reality. Yeah? First of all, garbage in, garbage out. All this historical data we have is a guideline. What happened over the long run in the past? Things change. Yeah? One of the big of the slides, I don't have it in here, but I like that very much, is that bonds can save your bottom when equity markets tank as long as core inflation is below 3%. Then you have a negative correlation. If core inflation is above 3%, they move in the same direction. So bonds don't save you. Keep that in mind. Yeah. Garbage in, garbage out. If you have fantastic assumptions for the Bitcoin going to 1 million, yeah, that might be right, but it also might not be right. So if you put completely unrealistic assumptions in your portfolio, that's why we do the past, you might not end up with the desired result. Then as we work with the model here, we assume that returns are randomly distributed. Eugene Farmer, efficient market hypothesis. There are Nobel Prizes on the ground for this work, but we'll have a closer look into that as well. And that the returns follow a bell curve. I've already introduced it. That is what we put as option traders in our models. That what is as a base assumption used for a lot of financial modeling. So, garbage in, garbage out. Will these returns hold in the future? Will these volatilities hold in the future? And is the correlation reliable? All of these are moving targets. Yeah? The only thing we had in here, that's the past. And it's a reasonable assumption that over the long run, these numbers might hold. They might not. So, just keep that in mind. Then, returns are randomly distributed and fluctuate around a mean. This is an example from one of another presentation I have out there. It was the Spider. I had 7,712 trading days. And this is the fluctuation around the mean we can see here. So, yes, it looks pretty random, but not perfectly random, because these spikes we see here to the upside and downside, and here to the upside and downside, here to the upside and downside, are not in line with theory. Why are we using the bell curve then, Torsten? Well, it's like you want to go through a foreign city, you look at a map. If the map would give you the cover 1-to-1, you're in the middle of the map. You couldn't use it anymore. So because it's the best we have, yeah? And the whole market works with it. They have additional assumptions in there and they're trying to be smarter, but it's a good starting point to say, obviously we're distributing around a mean here, and there can be fluctuations to the upside and the downside. And here the red line is our 1% standard deviation corridor. But if I take all these daily returns, which I have here in my chart, and say, okay, count them. Count how many returns did we have by 0.25% plus and 0.25% minus, etc., etc., etc. You see there's a bell curve. Obviously, this bell curve is a reasonable proof that over the long run, we have the bell curve, which I put in my model, and that returns might be randomly distributed. And I'm not negating that we have trends. It just says, yes, if we have a long uptrend and we have a long downtrend and we have a long sideways market, overall, we have the bell curve here. Yeah. it takes this shape. And then we already have the end of our portfolio construction mini workshop. I hope you have enjoyed that and you can put it in your models. The next presentation, I will start putting volatility, e.g. options, into our little mix. And thank you for your interest. Get ready for 2026. Here are a couple of book recommendations, especially if we talk about Our Markets Random, and Market Sense and Nonsense is about diversification. If you want to already go into option volatility and pricing, that was the book that was dropped on my desk on my first day as a junior trader, Option Volatility and Pricing by Sheldon Nadenberg. And you want to read about portfolio optimization, well, you read it, you might as well read it from the man himself, Harry Markowitz, who got the Nobel Prize for his works and revolutionized the financial industry. If you want to find a couple of articles and links, please visit our website. Most of my publications are in English on there. I publish usually in Macro Hive, and they have been picked up by a couple of other magazines as well. So I hope you enjoy that. And obviously now I have to slip you in the risk disclaimer. This is by no means investment advice. This is a presentation on a concept and how to apply it. Do not take this as investment advice. It is not intended as investment advice. Do your own research, and I shall by no means be liable what you do in your investment spare time. Pick up a book, check out YouTube, read the videos, build up your know-how, and this video shall only be helpful for you to say, yeah, fine, let's try that out. And he's given me a little guidance. I can experiment at home whether that actually makes sense, what he says. Thank you very much. I hope I see you soon on this channel. Bye-bye.